Hey, this note from the Federal Reserve that you're about to see could be bullish for us. I'm really excited for it, especially leading into tomorrow, where if you haven't yet watched my video, watch the video that's titled Watch Before May 11th, all about CPI tomorrow. But I really want to focus on what the Fed just said. It's Neel Kashkari, president of the Minneapolis Fed. Let's get right into what he said, and then I'm going to give you a conclusion at the end, which, let me just say, I was not expecting this, all right? Let's get into it. Quick note, remember, 6 days until we have the largest price increase ever for the programs on Building Your Wealth, link down below. Specifically, you want to take a look at that real estate investing one right now. You get 12 years of not only my experience, but you also get 35 years of my in-laws, Lauren's parents' experience, because Laconnie, for example, makes multiple appearances in our do-it-yourself property management course and rental renovations group. You get all of the property management, rental property experience from myself, Lauren, Connie, Bill, you name it, our entire family. Really incredible content, and a lot of folks have been checking out on both the Zero to Millionaire Real Estate Investing group and that Do-It-Yourself Property Management group as a bundle. So check that out before the prices go up, and you get a better deal if you bundle them together. Link down below. All right, folks, let's get into it.
Raising rates, and whether it's through a series of 50 basis points or maybe 75 does at some point come back on the table. If you're trying to increase supply through investment, you're cutting off your nose to spite your face. You want to. You want capital deployed to ease all the supply constraints, and it's going to be more expensive to do that every time you raise rates. It's almost a catch-22 and a very difficult and blunt tool that the Fed has to just try to destroy demand. It's a real problem. I don't know. You sure you want to keep doing this?
A really good question there, by the way, because the question is dude, lower rates would help us invest in the factories and in the supply chains to make them better. Obviously, my expectation here is the Federal Reserve's argument is hey, you got high enough valuations to finance, and we just want to get back to neutral. We don't need to stimulate more to finance your expansion. So while I like the setup, it kind of misses the fact that companies got plenty of money. But let's listen to the response from Neel Kashkari. He is the president of the Minneapolis Fed.
Well, we have our job to do. We have to bring inflation back down, and I'm confident we will do that. But remember, the cost of capital for most large firms is still very, very low.
Right.
They can still go fund themselves at very attractive rates. So I think we're a long way away from the cost of capital being the barrier, for example, to firms investing in the energy sector. I do think it's more lack of confidence on where energy prices are going to be over the medium term to see what kind of return they get on their investment, and also the regulatory environment that you spoke about.
Hey, Neel, the Fed has a dual mandate, and that's to focus on inflation, but to also focus on unemployment, the jobs market. In the past, we've talked about how the Fed probably has even more mandates than that, worrying about a series of other things, from the economy overall to what might happen with the stock market. Is it fair to assume, because at this point you sound like you are pretty laser focused on the inflation piece of it, understandably so, inflation is destroying things right now. Is it fair to assume that you're not paying that much attention as a body to what happens to the stock market at this point? It's going to be focused on inflation, and what happens to the market happens?
He's nodding.
Absolutely. I'll be honest with you. I never focus on the stock market as a goal. We pay attention to asset prices as it comes back around into psychology and spending behavior. But ultimately, it is our dual mandate that drives us. For 5 years, up until the pandemic, I was probably the most dovish member of the Federal Open Market Committee. And I took that view because we were undershooting on inflation, and I still saw there was slack in the labor market. So if you're undershooting on both sides of your mandate, that means that monetary policy is too tight. Now we have a very strong labor market, and we want to keep it strong, but inflation is much, much too high, and we have to bring inflation back down. And ideally, if we have monetary policy dialed in right, those two things will be in tension. We'll be at 2% inflation, and we'll be at a very healthy labor market, and we'll have confidence that we've got it right. But right now, it's just imbalanced, and we need to bring it back into balance.
You just said you don't focus so much on the stock market unto itself, but you do focus on the psychological impact of the price of assets.
Wealth
and
effect.
Effectively, what I imagine you're saying is the wealth effect, or the lack of the wealth effect. Given where you've seen assets move over the last month, how do you think that psychology has changed? Do you think that, and also given some of the other numbers you were just talking about in terms of how much household wealth families have, how much more does that have to come down to change the psychology?
Well, it's a good question. You know, when I think about this regime that we might be in a higher pressure equilibrium, the wealth effect is part of that. So stock prices were very high relative to pre-pandemic, home prices very high relative to pre-pandemic, and then even the lower income households that don't own stocks or don't own a home, many of them have much stronger, healthy balance sheets than they had before the pandemic. My theory is that all of that is leading people to feel more confident and to spend more, and maybe that's what's pushing us into this higher consumption, higher spending, higher inflation regime. So yes, the stock market has come down. Home prices are still very high. The latest data is they've still been quite robust, even though mortgage rates have climbed quite a bit just over the course of this year. And again, household balance sheets continue to be very strong. And so, you know, we just need to keep paying attention to the data. Some of the most recent inflation data on some measures is a little softer than we had thought might come in. So maybe there's some evidence that things are starting to soften just a hair. But we just need to keep paying attention to the data and seeing where it comes out before we can draw any conclusions.
Did you catch what he just said? And in my opinion, it's bullish. Inflation's actually already coming in lower than what the Federal Reserve was expecting it to. Remember, the Federal Reserve missed the boat in terms of the fact that inflation ran way too hot, way too fast. But their expectations were that it would slowly cool eventually, and now they're actually already saying that internally amongst each other, they're seeing more of a decline. We already know that the stock market needs to go down for the Federal Reserve to feel that individuals' wealth is going down, so they spend less money to drive inflation down. Now, that's not the goal, right? We know the goal isn't to bring stocks down. It's just that when you bring the stock market down and you bring the real estate market down, people spend less money and then inflation goes away, right? And now, obviously, he gave us a big hint here that, hey, stocks have kind of already gone down, but real estate, even though rates have gone up, still hasn't gone down. In other words, hey, we might still have to kind of tighten the screws on real estate a little bit. So they're watching and waiting for real estate prices to come down. Imagine being this group of people like, let's go crash stocks. Okay, let's now go crash real estate. Like, it's kind of wild and powerful, right? But think about it this way. Loretta Mester this morning said the following quote, "Volatility is painful but necessary to get inflation down." I wrote this on Twitter. This is why you should follow me on Twitter, @RealMeKevin. I wrote, translated, "Yo, we need stocks to drop so people feel poorer and then inflation will come down as people spend less. Don't worry though, we sold our stocks beforehand to avoid a conflict of interest." True, by the way. They stopped owning individual stocks and sort of being able to make these portfolio decisions kind of at the peak of the market in like November. And then they went into this crazy tightening cycle. So it's like, gosh, just copy the Fed. When the Fed sells, you sell. But they can't do that anymore, supposedly. Anywho, this lower inflation expectation, really big deal. Imagine if tomorrow, and maybe they already know this, right? Maybe they have their own estimates or they get a leaked early copy or whatever. Imagine if they already know the CPI is going to come in low tomorrow. In my opinion, bullish. Very, very bullish. If we get CPI that confirms the thesis that inflation maybe peaked in March and actually comes in even lower than expected, it could be very, very, very good, especially for risk assets, which are all kind of still selling off. Anyway, good luck out there. Thanks for watching. Check out the programs on your wealth. Link down below.